Hello, good morning, everyone, and welcome to the latest in our Novia Global Pulse Advisor webinar series. My name is Paul Foreman, International Sales and Technical Manager here at Novia Global, and delighted to say that we're joined by our friends from QB Partners once again this morning. We have John, Clare and Mike Foxall also on the presentation. Today's topic is UK pension changes and transitional tax-free allowance certificates. And given all of the changes that we've had in pension rules over the last few years, it's not surprising that there's some confusion out there amongst advisors and clients as to where we've come from, where we are now, and potentially with a new UK government installed recently, where we might be going to in the future. So this morning, John will be illustrating examples of how these new pension changes affect you and your clients when doing pension planning. Towards the bottom of the screen, you'll see a Q&A tab. So if you do have any questions, feel free to allocate them to the box. We'll collate them and discuss them at the end. Or alternatively, we do have plenty of time to run through a Q&A session if you'd rather add your question towards the end. Anticipating around about 35 minutes for the main body of the session today, and then questions thereafter. So that's enough from me. I'll hand you over now to John for today's session. Thank you, John.
Thank you, Paul. Thank you very much. Good morning, everyone. So my name is John Clare. I'm a pensions consultant at QB Partners. We provide technical specialist support to financial advisors. And with all of the changes to UK pensions, it's an area that we've been getting a lot of inquiries on, and there is a lot of confusion. So thank you to Novia for organising this, and thank you everyone for joining. Hopefully, you'll all learn something today. So, the main focus of this is going to be looking at the abolishment of the lifetime allowance, talk about the new allowances that have been introduced, and then we'll take a close look at the transitional tax-free amount certificates that have been introduced, what they are, when they may be needed, and we'll cover a case study and some client scenarios. Okay, so I think it's going to be useful to cover the foundations here before we move on to the transitional certificate section. So we'll just look at the announcement of the lifetime allowance abolishment, quick look at the history of the lifetime allowance, and cover what the new allowances are, highlight the levels, who they apply to, before we move on to a case study and some client scenarios for transitional certificates. As Paul said, shouldn't take too long to get through these slides, should have plenty of time for Q&A at the end. Okay, quick introduction to QB Partners then. We were founded in January 2009. We provide cross-border independent specialist support to professional advisors, financial advisors, and also to product providers. We provide a practical solutions-driven approach. We don't sell any products. We work with advisors to highlight planning opportunities for their clients and help to implement those planning opportunities correctly. Areas of expertise include international pensions. Of course, that's my area. We also provide support with cross-border trust and estate planning, wealth insurance, and business protection. And as we'll talk about today, we've got a new service which looks at the transitional tax-free amount certificates, and that's something that we continually develop. If there are any new opportunities, we offer services and solutions to advisors to help their clients. Okay, so our core service, we're completely independent. We have panels of solutions, but we're not tied to any provider. We provide suitability reports for advisors and clients in the right circumstances to help implement planning correctly. And all of the support that we offer is covered by PI insurance and backed up by due diligence. And working with QB Partners as a financial advisor or product provider helps to reduce risk in the business. Okay, so introductions out of the way. Move on to the first slide here, talking about the abolishment of the lifetime allowance, which we found out about in March 2023. Jeremy Hunt confirmed that we'd be waving goodbye to the lifetime allowance. It was quoted that one key reason for the abolishment was to incentivize skilled workers currently considering retirement to remain in employment, and also to encourage the likes of NHS doctors who had already left the workforce, perhaps because they had reached the lifetime allowance limit with their pensions, and pension contributions just weren't attractive for them. So encourage them to return to the workforce, where they could continue to contribute and save tax efficiently into a UK pension. So first of all, following the announcement in March, we had the lifetime allowance charges reduced to nil in April 2023. And this gave the government and pension schemes time to adopt and introduce new rules that would apply and that now apply from April 2024 with the full abolishment of the lifetime allowance. So with the lifetime allowance being abolished, we found out very quickly that there would be some new allowances to replace the lifetime allowance to still restrict the amount of tax-free cash available from UK pensions. So first of all, we found out about the lump sum allowance and also about the lump sum and death benefit allowance. Much later, in November 2023, very late November, we also found out that there would also be an overseas transfer allowance used to restrict the amount that could be transferred to QROPS. This gave a short window for appropriate clients, non-UK residents, people planning to relocate, or people concerned about a Labour government, to transfer to QROPS without any limit on the amount that they could transfer. So quick history, the LTA was introduced on A Day in April 2006. It was introduced by the Labour Party. It was a mechanism for limiting tax relief pension savings in UK registered schemes. That lifetime allowance limit was also, of course, used to restrict the amount of tax-free cash that could be paid to a UK pension member. It was originally set at 1.5 million. You'll see on the next slide, and many of you will know that fluctuated quite a lot over the long time that it was in force. It peaked at 1.8 million, and the lowest point we had it was 1 million. People could contribute to a pension over this limit, but ultimately, when accessing benefits or attaining age 75, if there was an excess, there would be a charge of 25%, or potentially up to 55%. And the 55% charge applied when taking the excess over the lifetime allowance as a lump sum. So members of UK pensions in 2006 on A Day were able to benefit from enhanced or primary protection. And then subsequently, whenever the lifetime allowance was changed, it was changed a lot, individuals in the right circumstances could benefit from fixed or individual protection to protect the value of their pension and provide them with a lifetime allowance limit that was higher than the amount it was reducing to. So we can see here that in 2006, it was 1.5 million, peaked at 1.8 million in 2010, ultimately fell to its lowest point in 2016. And we've got those quite random and not very nice round numbers from 2018 because the lifetime allowance started to increase with inflation before it was ultimately frozen. And since 2012, with the lifetime allowance reducing, and with rising inflation and rising pension funds, more and more UK pension members were being hit by the lifetime allowance each year. These previous limits, I'll come back to the relevance of them and the significance they still play today when we look closely at the transitional certificate section. Okay, so as I mentioned, the lifetime allowance is gone, but we have 3 new allowances which are used to restrict primarily the amount of tax-free cash available, in addition to the amount that can be transferred to QROPS. First of all, then we have the lump sum allowance introduced on the 6th of April, and this allowance is used to restrict the amount of tax-free cash, PCLS, that is available from UK pension benefits. It's initially set at 268,275, which of course is 25% of the now abolished lifetime allowance limit. So ultimately, with the abolishment of the lifetime allowance, the tax-free cash position is not improved. We still have, of course, the 25% limit, so 25% of the value of your UK pension benefits, or 268,275, whichever is the lower. So when any benefits are accessed from the 6th of April from a UK pension, the UK pension scheme will consider any previous tax-free cash lump sums that were received prior to 6th of April, and any tax-free lump sums that are received after the 6th of April, and they will be deducted from that 268,275. Conversely, any individuals that had lifetime allowance protection in force, fixed protection, individual protection, primary or enhanced, they may be able to benefit from taking a high level of tax-free cash and will have a higher lump sum allowance. The lump sum and death benefit allowance. So from the 6th of April, we now have a potential tax on death before age 75. This only applies when death benefits are paid out as a lump sum, and it only applies where the lump sum paid exceeds the member, rather than the beneficiary, the member's available lump sum and death benefit allowance. So beneficiaries can still elect to receive the death benefits as an income, and that will still be tax-free. But where they elect to receive benefits as a lump sum, the lump sum and death benefit allowance will be used to test the lump sum, and any excess will be subject to tax at marginal rate. So this allowance also introduced on the 6th of April. As I said, the position is changed on death before age 75 only. After age 75, the full amount is still subject to UK income tax. This lump sum and death benefit allowance is not relevant for UK pension members that are past age 75. And any lump sum allowance or any lifetime allowance that has been used will be deducted from the lump sum death benefit allowance, which is set at 107,300, consistent with the lifetime allowance. So any lifetime allowance usage will be taken into account when a scheme pays out any death benefits, and it is 25% of the lifetime allowance usage, i.e. the assumed tax-free cash payment is deducted from that 107,300 limit. And again, just like the lump sum allowance, any lifetime allowance, individual or primary protection, can be used to increase the allowance. Okay, so the third and final new allowance that we have is the overseas transfer allowance. And as I mentioned, this was announced much later than the other allowances, and provided a short window for UK pension members with funds exceeding the lifetime allowance to transfer to QROPS uncapped and without any lifetime allowance charges. Potentially, the lateness of the announcement prevented a fire sale for UK pension transfers to QROPS in late November. With the overseas transfer allowance coming into force from the 6th of April, it certainly didn't allow much time for individuals that might benefit from QROPS, might want to transfer to QROPS over the lifetime allowance without any restrictions. It didn't give them much time to receive advice and to plan. So prior to 6th of April 2023, pension transfers to QROPS were subject to a 25% lifetime allowance charge. So it was always a 25% charge rather than a 55% charge on a transfer to QROPS. As I mentioned, 23-24, no lifetime allowance charges were incurred. And now from the 6th of April, any transfers, instead of being tested against the lifetime allowance, will be tested against this overseas transfer allowance. And just like the lifetime allowance charge, the overseas transfer charge that can apply on the excess is also set at 25%. So it was initially directly linked to the lump sum and death benefit allowance, and therefore set at 1,073,100. A slight difference from the lump sum and death benefit allowance and the overseas transfer allowance. When a UK scheme is calculating the remaining allowance, any previous lifetime allowance used is deducted wholly from the overseas transfer allowance. So if someone's crystallised benefits in the UK prior to the 6th of April, and say they've used up 50% of their lifetime allowance, then they will only have 50% of the overseas transfer allowance remaining. With the lump sum and death benefit allowance, it is only 25% of the amount crystallised and the lifetime allowance used that is deducted from that 1,073,100. And with this being an overseas transfer charge, it has caused quite a bit of confusion. We've already had overseas transfer charges, and those have been enforced since 2017. And as you may know, in order to transfer to QROPS now, the member must satisfy and continue to satisfy for 5 years one of a relatively small number of exemptions. I'll just cover them on the next slide. That still applies. You need to now, to avoid an overseas transfer charge, satisfy an exemption, continue to satisfy an exemption for 5 years, and also ensure that the transfer amount is within your available overseas transfer allowance. Yeah, and just to cover quickly these exemptions then, transferring to QROPS, for most cases now, you need to be living in the same country as the receiving scheme or resident in the UK or EEA, and be transferring to a EEA-based QROPS or possibly a Gibraltar QROPS. There are also exemptions on transfers to genuine occupational schemes. Okay, so of course we've now got the Labour government. There's been a lot of questions with regards to what will Labour do. There's a lot of concern, there's a lot of uncertainty. And this is because following the announcement that the lifetime allowance would be abolished, Labour were very quick to criticise the move and challenge their reasoning. And as I mentioned at the start of this presentation, it was of course Labour that introduced the lifetime allowance. They've introduced it. The Tories have abolished it, and very quickly Labour and the Shadow Chancellor Rachel Reeves promised that they would reintroduce the lifetime allowance when they came into power. So that was last March that they made that promise. They were relatively quiet on that point, and of course it's taken until now to come into power. But during that period, there's been a lot of concern, particularly amongst pension members with funds close to or in excess of that lifetime allowance. And I think that uncertainty, that concern that a Labour government will restrict or reduce the tax efficiency of their pension has caused many pension members to crystallise the benefits so that if the LTAs were introduced, they won't be subject to LTA testing and charges sooner than they otherwise would. And many advisors and their clients have also been looking to transfer to QROPS to move the fund out of the UK and to provide further protection against a potential reintroduction of the lifetime allowance. Now, Labour recently U-turned. It was announced after doubling down on their plans to reintroduce the lifetime allowance. Within the same week, it was reported that they've U-turned on these plans, and this was left out of the Labour manifesto. In fact, in that manifesto, there wasn't really much information or reference to pensions. But what it did do is it alluded to a future review of the pensions and retirement savings landscape. So that's something that we're eagerly awaiting. We've of course got the King's speech today, but I think the next time we'll get news about pensions will likely be late September, I think, at the earliest, when we have the autumn statement. Okay, so moving on to the main focus, really, of this presentation, Transitional Tax-Free Amount Certificates, or TTFACs. So these are available to accurately reflect the tax-free amounts received prior to the 6th of April, when the pension scheme is applying a lump sum allowance or lump sum and death benefit allowance. So when accessing benefits from UK pots post 6th of April, the pension scheme will use a standard calculation to work out the members' available allowances. This standard calculation will deduct 25% of the lifetime allowance used from the standard allowance. In most cases, this is going to be correct and it's not going to provide an impact, and therefore most UK pension members will not require or benefit from a certificate. However, where a member does wish to apply for a certificate and rely on a certificate in respect of any future lump sums paid, then an application must be made prior to any future BCA. So before crystallising any further benefits, you need to consider for clients that might be impacted whether a certificate would be beneficial. When a certificate is produced, that must be used by the pension scheme, even if that standard calculation would have provided better results and a higher tax-free amount entitlement. So it's really important that clients don't just go off and apply for one just in case there is an increase, because if it comes back with negative results, the scheme will rely on that and they will have lost out on some tax-free cash entitlement. So when should people apply? When should advisors be looking at TFACs for their clients? So first of all, a certificate is only available to UK registered pension members who have crystallised benefits prior to the 6th of April 2024. If your client hasn't taken any benefits from their pensions, if they've already transferred all of their funds to QROPS and they don't have any money in a UK scheme, then a certificate isn't relevant or valid or required. An uplift, however, may be available to individuals, and that uplift can be significant. I'm going to talk about a case study and show just how much tax-free cash can be accessed through a certificate in the right scenarios. So some situations include defined benefit pensions. So if you have any defined benefit pension clients that have started to receive an annual pension from the defined benefit scheme, it's very unlikely that the amount of tax-free cash they've received correlates to the amount of lifetime allowance used. So, of course, the lifetime allowance usage was 20 times the annual pension. So if the tax-free cash received is below 5 times the annual pension, which in many cases it will be, and many defined benefit pension members, of course, will opt to receive a higher annual pension in favour of a lower or nil tax-free cash payment. So in those situations where the client has other UK pensions that are uncrystallised, before accessing those uncrystallised pensions, it is worth considering the application of a transitional certificate. Transfers to QROPS is a big one, and that's where the case study focuses. And that's because transfers to QROPS do not pay out any tax-free cash. On the transfer to QROPS, the benefits are crystallised pre-6th of April under BCE number 8, and in connection with BCE number 8, there is no tax-free cash payment. So HMRC have categorically confirmed that tax-free cash, transitional tax-free amount certificates, are available for individuals that have crystallised benefits under BCE 8. Unused funds past age 75 is also an interesting one, where if your client, if you have any clients that are over age 75 and at age 75 have elected to defer their PCLS and their tax-free cash payments, then the benefits would still be tested, and under the standard calculation, it will be assumed that that pension member has received 25% tax-free cash at that benefit crystallisation event. So potentially, without a certificate, they've lost their tax-free cash by choosing to defer that beyond age 75. So before they crystallise any more benefits, you need to consider the application of a TFAC. And then the final one is lower lifetime allowance limit. So we looked at the table and looked at the different levels of lifetime allowance and how it's fluctuated over the years. Most of the time it was higher, but there was a few year period where the lifetime allowance was below 107,300. And if your clients have crystallised benefits during those years, then there is potential for a slight uplift to their tax-free cash entitlement. However, in most cases where people have crystallised benefits, taken 25% tax-free cash in the UK in previous years, when the lifetime allowance limit was higher, the standard calculation will likely provide better results. Just a very quick scenario. If, for example, someone in 2015, when I think the lifetime allowance was 1.5 million, crystallised 1.2 million of their pension, so still had 300k of lifetime allowance remaining, and that 1.2 million crystallisation provided a tax-free cash payment of 300,000, then as of today, they still have some lifetime allowance remaining and still have access to some tax-free cash entitlement under the standard calculation. If they were to apply for a certificate from poor advice or from misunderstanding the rules, or thinking that they can just apply if it's better, they can have that. If it's worse, they can throw the certificate away. If they were to apply for a certificate, that certificate would come back and show that because they've already had 300k in tax-free cash, they've exceeded the 268,275, they cannot take any more, and their lump sum allowance will be set at 0. So really important that clients in those situations don't rush off to apply for a certificate without speaking to advisors and taking advice. Finally, and I'll come on to this in a little bit more detail, it can also be beneficial to obtain a certificate where a UK pension member below age 75 has used 100% of their lifetime allowance. And that can be beneficial not to increase the lump sum allowance and the tax-free cash entitlement, but to increase the death benefit allowance to potentially benefit the beneficiaries. Okay, so case study here, we've got a Mr. Smith. Mr. Smith is 60 years old. He's had a successful career in the UK and due to retire imminently. He wants to take his tax-free cash entitlement and is looking at his pension benefits. He's got 2 million in total UK tax relief funds. That comprises of 1.4 million in QROPS and 600k in a UK SIP. The 1.4 million in QROPS is derived from a transfer up to his protected lifetime allowance limit in 2022 of 1.25 million. So QROPS were long used for lifetime allowance planning to help protect any investment growth from future lifetime allowance charges. Mr. Smith received advice to transfer to QROPS for that reason in 2022, and that 1.25 million has now grown to 1.4 million. So Mr. Smith's advisor is looking at the tax-free cash available from QROPS and from the UK pension and has engaged QB Partners to assist in calculating these allowances. QB Partners offer a TFAC report service. We've produced a report for Mr. Smith, and the following slide is an extract from this short report. So the relevant section here of this report is these figures, and we've calculated that under the default allowances that the scheme will apply in the absence of a certificate, this client, Mr. Smith, has no lump sum allowance available, and he also has no lump sum death benefit allowance available. Now, we've looked at the client details and what allowance he might be able to obtain through the process of applying for a Transitional Tax-Free Amount Certificate, and we've confirmed that the lump sum allowance available via certificate is 312,500, i.e. 25% of his protected lifetime allowance. And with regards to the death benefit allowance, you can also have that reset to 1.25 million. So as we covered, under the standard default calculations, his lump sum allowance is going to be 0 in the UK, and that will apply automatically at the next relevant benefit crystallisation event. So any UFBLS payment, any tax-free cash payment in the future, beyond the 6th of April, will trigger that RBCE, and the client will lose the opportunity to obtain a certificate, and the scheme will automatically apply that 0 lump sum allowance. Through a certificate and through the correct application and providing the required evidence, Mr. Smith can increase his UK lump sum allowance from 0 to 312,500. And this is because when the benefits were tested and transferred to QROPS under BCA, no tax-free cash was paid to the member. And that's the important thing. When we apply for a certificate, the scheme will ask a few questions. It's a very short questionnaire. And one of the questions is, what benefit crystallisation events has there been? And in there, you'll confirm BCA, confirm that the amount crystallised. And then the next question is, what tax-free cash was paid in relation to this crystallisation event? And for a transfer to QROPS, the answer for Mr. Smith here is nil. So just to confirm, although his lump sum allowance through a certificate has increased to 312,500, he's still limited to 25% of the value of his 600k UK pension. So on the basis that he is looking to access tax-free cash now, he'll be able to take 150,000 of that 600k tax-free. That wouldn't be available if he doesn't obtain a certificate. Furthermore, and something I'll come on to in a bit more detail, but once he's gone through that process, he can also access up to 25% of his protected lifetime allowance limit from the QROPS. So therefore, the QROPS exceeds 1.25 million. So this client, in addition to the 150,000 from his UK pension, following a TTFAC application, he can also access 312,500 from his QROPS. And that payment doesn't impact or interact with his UK lump sum allowance under current rules. And again, the lump sum death benefit allowance without a certificate is 0, and with a certificate we've shown that it can be reset to 1.25 million. And it's actually set at 0. I mentioned earlier that with the lump sum death benefit allowance, unlike the overseas transfer allowance, when we look at the lifetime allowance usage, we look at the legislation, what should happen is 25% of the lifetime allowance used before it was abolished should be deducted from the client's lump sum and death benefit allowance. However, a strange nuance in the legislation means that when we go from taking up to 99% of the lifetime allowance to 100%, it goes from decreasing the lump sum death benefit allowance by 25% to instantly setting the allowance at 0. And that's the lump sum allowance and the lump sum death benefit allowance. A little bit more information on that. This is something that will impact many UK residents and UK pension members in drawdown. Hopefully, we see something in the future that updates this legislation to confirm that actually, instead of setting the client's allowances to 0 automatically, it should be reduced by 25% of the lifetime allowance. That's the logical reduction, and that is the reduction that would be available following the application of a certificate. And just to reiterate, with the lump sum death benefit allowance, any excess, and therefore any payment received as a lump sum on death before age 75, where the member has crystallised 100% of their lifetime allowance and have not obtained a certificate, the full amount will be subject to income tax at the beneficiary's marginal rates. So look at the 99% reduction in comparison, and we can see that because only 25% of the lifetime allowance used is deducted from the lump sum and death benefit allowance, someone that has crystallised 99% rather than 100% would still, without the application of a certificate, have an allowance of 807,500. So regardless of how benefits have been crystallised, where a UK pension member has 0 LTA because they crystallised 100% through whatever BCE, they should be considering the application of a certificate to increase their lump sum and death benefit allowance. It may not increase their lump sum allowance, but if they're under age 75, that increase to the lump sum and death benefit allowance could be very attractive. Just very quickly then, coming back to the double tax-free cash rule that I mentioned that was available for that client. This is something that was reported by the Telegraph back in January, discussed by a number of industry experts, and everyone thought this is too good to be true, a loophole in the legislation that they have plenty of time to address. and you know that was our view, that it would be addressed, that it is a loophole, but seemingly it is available, and we've highlighted the one client scenario where QROPS member can access their tax-free cash from their QROPS and still take tax-free cash from the UK pension. And HMRC have been very, very clear that a lump sum allowance increase is available via a transitional tax-free amount certificate where benefits have been crystallised under BCE number 8, i.e. transfer to QROPS. So it's not an area of planning that we're promoting. It's only possible in specific client situations, and even then, great caution must be taken to implement the planning correctly and avoid any unnecessary taxation or restrictions. But for some individuals, it is possible, and where we're receiving inquiries, it's something that we're happy to provide support and help to implement correctly. Okay, so just a quick recap then. So although the lifetime allowance abolishment is very positive and something that advisors and everyone in the industry has been calling for, as more and more UK pension members have been reaching that lifetime allowance limit and getting caught by lifetime allowance charges, it is still something that advisors have had to get to grips with, understand the new allowances, and consider whether any of their own clients are impacted. For most, as we've covered, the tax-free cash position will be the same, and the application of a certificate won't be necessary. But there are some situations for clients that have crystallised before the 6th of April where a TFAC can be very beneficial, and you should consider obtaining that certificate before they crystallise any further benefits, before they trigger another BCE. So in particular, clients that have transferred to QROPS and clients that have crystallised 100% of their pension can receive a significant uplift to their lump sum allowance and respectively the lump sum and death benefit allowance. Okay, hopefully you found that helpful, and hopefully we've got some questions coming through, Paul.
Yeah, I've collated a few come through here for you, John, and also there's a couple I had sent to me separately yesterday. But looking at today's questions, going back over the example that you gave earlier on with the case study, can you just clarify, was it the ability to access 150,000 PCLS from the UK scheme plus 302,500 PCLS from the ROPS, or was it effectively a cap of 312,500 for the combined PCLS, meaning effectively 150,000 from the UK and 162,500 from the ROPS as a PCLS?
Yeah, very good question. So effectively, it's been confirmed in the legislation that the lump sum allowance that applies to UK pensions is separate from the lump sum allowance that applies to QROPS. So clients that have UK pensions and QROPS will effectively have two lump sum allowances. Of course, where the transfer occurred pre-6th of April, under current rules, that lifetime allowance usage will reduce their lump sum allowance in the UK, but if they obtain a certificate, they can get an uplift back to that UK lump sum allowance. And in that client scenario, that client could take 150k tax-free cash. They could let their pension grow as well and ultimately take up to 312,500. And that payment from the UK pension would not interact with or impact their ability to take a further 312,500 from their QROPS. So even without a certificate, if they've got a QROPS and it's uncrystallised, you can take the tax-free cash from that up to the old LTA or the lump sum allowance, and it won't interact or reduce the UK lump sum allowance.
Great stuff. Thanks for that, John. In terms of practicalities, how do you apply for a TFAC certificate? Is that something the individual does themselves, or is it in liaison with the provider?
Yeah, the process itself, it's through a UK registered pension scheme, and the many schemes now offer applications or will provide a list of requirements. Ultimately, the scheme will want to see confirmation of any benefit crystallisation events. They'll want to see any tax-free amounts received and evidence of that. And yes, just supporting evidence, and those are really the main questions that will either be provided on a letter or on an email, or more likely with many UK schemes now, there will be a specific application form that they use.
Great stuff. Thank you. And then just looking at another one here. In terms of reporting to HMRC, when someone does do a transfer overseas, is that reporting 5 or 10 years currently?
The QROPS provider has a 10-year reporting requirement for QROPS. So ultimately, when tax-free cash is paid from a QROPS, if it's paid within 10 years of transfer and within 10 years of the member becoming non-UK resident, then that payment is reported to HMRC by the QROPS provider. Doesn't necessarily mean there's going to be any tax implications. It just means that HMRC can monitor and make sure that the scheme isn't paying out any tax-free cash early, isn't paying out any higher levels of tax-free cash than is permitted under UK rules. You know, covering what we've just spoken about, how there's a separate allowance, but and ensuring that they don't exceed that allowance from QROPS, and making sure that the QROPS provider doesn't transfer to another pension scheme that doesn't qualify as a ROPS.
Right.
So yeah, short answer, 10 years, but in most cases, it doesn't really impact what they can do with the QROPS.
Right. So one of the questions I was asked in a similar vein yesterday is in terms of transferring to a ROPS and where death does occur before age 75, is there any scenario where there is an overhang and the lump sum death benefit allowance would apply to that QROPS if death occurred within a short window after transferring?
No, so it appears very clear in the legislation that the lump sum death benefit allowance applies to UK registered pensions only, and there isn't any reference to QROPS provider being restricted on death before age 75 on what they can pay out tax-free. So QROPS members' slight benefit over UK pensions is that it won't be tested against that lump sum death benefit allowance. And effectively, the way that they can allow that is by restricting, with the overseas transfer allowance, the amount that can be transferred to QROPS in the first place. So you restrict that to 1073. Any investment growth plus that amount can then be paid out as a lump sum death benefit allowance to a UK beneficiary without being subject to UK tax on any excess over what the member's UK lump sum and death benefit allowance might have been at that time.
Great stuff. Thanks for that. And another question that I received yesterday was regarding age 75. And under the previous regime with the lifetime allowance, there was a specific test at age 75. What happens now?
Yeah, so that benefit crystallisation event at age 75 I referred to with regards to unused funds. And at the moment, there isn't any test at age 75. And the lump sum allowance still applies beyond age 75. But of course, the lump sum death benefit allowance falls away. That's only applicable on death before age 75. But with regards to lump sum allowance, individuals can defer their PCLS and take tax-free cash if the scheme rules permit it beyond age 75. There's no testing against lifetime allowance.
Great stuff. Just one question, asking a bit of clarity. So earlier on, you said that registered pension scheme issues the TFAC, but a QROPS is not a registered pension scheme. So can you just clarify again how that will be obtained?
Yeah, so to be absolutely clear, a TFAC these transitional certificates are only available for UK registered pension members and only valid to UK registered pension members. So when a QROPS member wants to take tax-free cash, the overall limit that they can take is still restricted by the overseas transfer allowance in the same way that it used to be restricted by the lifetime allowance, but it's just restricted at the 268,275 level or higher if they've got protection. The QROPS provider does not need to discount the lump sum allowance by any previous BCEs. And in itself, when we talk about the transfer to QROPS in itself, before the 6th of April, reducing the lump sum allowance and the lump sum of death benefit allowance, it wouldn't be logical for a QROPS provider to restrict a member's tax-free cash by the UK lump sum allowance. So the certificate is only valid to UK registered pension members, and it's only available from UK registered pension schemes.
Great stuff. Not sure if you've got a pen and paper, but there's one with numbers here for you. But just ask that we have a client who has a protected LTA of 1.8 million. They've already crystallised 201,000 from that scheme. Should they be applying for a TFAC? As if he doesn't apply, he will be allowed 268,000 rather than 249k that's remaining, which is obviously 19,000 more.
Yeah, okay. Good question. I think it depends on how the benefits were crystallised. If they were crystallised just as a tax-free cash payment, then unless that tax-free cash payment fell between the period of the lifetime allowance being reduced to 1 million and the 6th of April this year, then there wouldn't be any uplift available. If it fell in that period, there'd be a slight uplift. Ultimately, though, the scheme will just need evidence of that certificate. If that certificate is still in force, they'll need evidence that the client has valid lifetime allowance protection and should be able to pay 25% tax-free cash under the standard calculation, which will just deduct 25% of 201k from their enhanced lump sum allowance. So for 1.8 million, they'd have a 450k lump sum allowance with evidence of a valid lifetime allowance protection certificate. They'd have 450k. That would be reduced under the standard calculation by 50k to reflect that they've already crystallised 200,000. Now, if that 200,000 was a transfer to QROPS, for example, and they hadn't actually received 50k in tax-free cash, then they'd be able to apply to the UK registered scheme to get an uplift of that 400,000 remaining lump sum allowance up to 450. But in those instances, it just depends when it was crystallised. Like I said, if it was during the period where the LTA was 1 million to now, or to the 6th of April, then slight uplift possibly available. If it was prior to the LTA being lower, then it wouldn't be available.
Great stuff. And then just a generic one to end with, there's potentially rumours circulating that Rachel Reeves might consider IHT on pensions as one of the changes going forwards. I don't know whether you've got any views on that. I suppose that's the kind of thing that will come out in a King's speech or an autumn statement in the future, but I don't know whether you've heard any of those whispers.
Yeah, it's something we're monitoring and we're discussing internally. We regularly provide budget analysis and commentary on any relevant legislation changes or discussions and rumours. With regards to the inheritance tax, I don't think we're expecting that will be applicable to pensions in the future. Of course, with this Labour pensions review, we're eagerly waiting to see what comes out. I think probably in the autumn statement rather than in the King's speech, but we'll be we'll be watching that this later this morning as well.
Great stuff. Well, as ever, thanks for your input today, John. You think you've earned yourself a coffee and a biscuit there, and a bit of a rest, quite a technical session. But the guys at QB Partners do issue newsletters and updates, and they've got a great LinkedIn page, so well worth following. And obviously, if you have any clients that fall into these categories that we've discussed today, they'll be only too pleased to help you there. We will be issuing a recording of today's session, so if you want to go through any of the pertinent points again, feel free to do so. And if you have any colleagues who maybe couldn't join us today, definitely want to share if you think this could be of interest for them going forwards. We will be doing another session towards the end of August with Waverton, one of our investment DFM partners. But that just leaves me to say thank you once again to the guys at QB today for their invaluable input. And to you for joining us, thank you very much for your time, and see you next time. Thank you.
Thank you very much.